Okay, so this is Chapter 9, Market Efficiency and Behavioral Finance, and inside of Chapter 9 we'll also talk about technical analysis. So the learning goals are really to describe this concept of efficient markets, market anomalies, and challenges that investors may face when markets aren't efficient. So when they become greatly overvalued or greatly undervalued, these are opportunities. We're going to talk about decision traps that lead the common investor to the same errors continuously. We're going to look and talk about behavioral finance, how the people's behavior as human beings gets incorporated into their trading activities, and how your human nature actually works against you while trading. And these are things that you have to fight against and learn to not to do. But it's very difficult as a person with a certain amount of emotions and skill sets not to try to apply your real life concepts onto the stock market, which usually gets you into trouble. We're going to talk about technical analysis, why it's important, how it's utilized, and then we're going to compute and use technical analysis to evaluate stocks and the market as a whole. Okay, so let's take it's a nice day, so let's take a random walk. And in a random walk, we really don't know where you're going to end up. So you start here and you walk somewhere, who knows where you'll be. Sort of like putting a blindfold on you and pushing you out and asking you to walk for 20 minutes, and we'll see where you wind up. If you're not dead, at the end of that, it's going to be somewhere you didn't expect. So they use this term random walk for a theory onto stocks, saying that stock movements are completely unpredictable and there's no way of knowing where prices are headed. So any day in the stock market when you wake up, there's no way to really predict where the stock prices are going to end at that day. So certain studies have shown that stocks don't move in neat or predictable patterns. So there's no way of really guessing or estimating where the stock price is going to be. So the random walk says any type of financial analysis, technical analysis, inside information, any information about the stock or the stock market itself will do no good to you, and it won't help you to discover what the stock price will be. So the pattern is a natural outcome of markets that are highly efficient and respond quickly to changes in information. Is sort of the random walk theory. Is this efficiency is already built into the market, so you can't beat that efficiency before it's in the market, so to speak. And one of the classic studies they did is ever hear, is anybody here like monkeys? Don't raise your hand if you like monkeys. Okay, so everybody here likes monkeys. Now, take a monkey and you give him some shit to throw, and he throws it at the Wall Street Journal. It's actually, they say darts was one thing, but they had one where the monkey, I guess it was paw. Somehow the monkey was choosing the stocks. They have one where somebody just takes a dart and throws darts at the Wall Street Journal, and that picks a set of stocks. So here you get 20 stocks randomly chosen by either a monkey or the throw of a dart, and you put that portfolio together, and that winds up beating most of the professional traders. So random selections of stocks wind up beating a large percentage of the personal traders. So that's one support for saying, well, if these traders know what's going to happen and they're supposed to know the directions and what stock price is going to turn into, why can't they beat a random selection of stocks? Now, if we refine this random walk theory, we can refine this down to make some hypothesis. So the first thing we have to think about is the concept of an efficient market. So for a market to be efficient, all information has to be reflected in the stock price, and any new information that comes out has to be accurately reflected and change the stock price to reflect it. Basically saying some piece of news comes out and the stock price changes accordingly to how that news affects the valuation of the company. So for the market to be efficient, we have to say that there's many knowledgeable investors who are actively analyzing and trading stocks. And I would say that in the stock market, we do have that. We do have a lot of highly knowledgeable people and investors analyzing and buying and selling stocks. But on the other side of this argument, there are a lot of people who are not knowledgeable and they're trading stocks also. So these are the people that we worry about because they can actually make the market inefficient. So if these people feel that a stock should have a PE of 200 is okay, they'll keep buying the stock, keep pushing it higher, where the valuation and other technically trained people would say that's really not a good value. So there's a kind of a chink in the armor there. If we're looking at information is widely available to all investors, well, public information is widely available, especially through the internet. You come up with a the company has some news or something happens, and through all the different avenues of the internet, this information comes out, and everybody pretty much finds out around the same time. The only problem here is that what about that information, like inside information or information that isn't widely released on the internet, that only a few insiders know? So that could be an issue to efficiency. But for a market to be considered efficient, we have to ignore that there are no knowledgeable investors trading, and we have to ignore that there's no information that's not widely available to everybody. Third events such as labor strikes, accidents tend to happen randomly. So that has to be, for the market to be efficient, these things have to, and that's pretty much true, they do happen randomly. Investors react quickly and accurately to new information. This fourth one, I think, is the big problem and why efficient markets aren't always so efficient. There are times where markets are more efficient and less efficient. So there are points in time where investors are a little bit more realistic and the attitudes are a little bit more on target. But there are times when markets become greatly inefficient, greatly overvalued or greatly undervalued. And one of the reasons is how investors react to information. So sometimes information comes out and investors react very aggressively in the wrong direction. So a bad piece of news comes out, say in the 60s, President Kennedy was shot. And that was, some bad news. The stock market went down quite a bit because of this news. It was an overreaction of investors because the death of the president, while tragic, did not have a huge impact on the profits of companies or the economy in the next couple of years, as much as investors had thought. In your time, we had the terrorist attack on the World Trade Center, and then after that happened, the stock market was actually closed. And then when it finally opened, it went down tremendously. But again, that was an overreaction in some respects because the stock market did come back relatively quickly a year or so later. And that's actually sort of the bottom of the stock market at that point. After that disaster, the market hit its bottom and it turned around quickly. So while these events are, this information is, investors react to it, they're not always reacting accurately. And sometimes they may be acting too quickly or not quickly enough. So you could see that in order to have an efficient market, sometimes these things are more true and accurate than other times. And that's why we do have this shift in efficiency of marketplace, and that's why we do sometimes have the tech bubble of 1999, the tech bubble of 2014, the real estate bubble of 2006 and 7. And they run in cycles. Okay. So here is, this is Walmart's quarterly revenues. Isn't that a nice upward trend in revenues? So this is what investors want to see. An upward trending results in revenues and hopefully in profits as well. And this is an information that after a while investors kind of find this predictable that Walmart's going to beat last year's revenues. And how is Walmart doing this from 2000 to 2012? It's quite simple. They're just opening up new Walmart or Sam's Clubs. And you open up a new Walmart or Sam's Club, and then you get more business. There was a time where there was no Walmart in this area. No Walmarts. We had TSS. We had Caldors. No Walmart. But Walmart comes in, and all those stores go away. Because they're quite successful, and people like shopping at Walmart, and there's a low price, so they're going to get revenues. So as long as they have the ability to expand, They're going to increase their revenues, and it's going to be quite predictable. However, if you see the stock price, it's not quite as reflective as the revenue chart of Walmart. You would expect that Walmart stock continually goes up along with the revenues. But you see, what this is demonstrating, there are some times where there's some inefficiency in Walmart stock, that it gets overly punished and goes down more than it should, and sometimes gets overly rewarded. And a lot of that has to do with the market, the risks of the marketplace in general. If it's a bad stock market, it doesn't matter how good Walmart's earnings and revenues are, it's still not, the stock could still possibly go down just based on all the negativity surrounding the stock market and the economy. So sometimes the firm's performance isn't 100% tied to the stock price. And that would be an example of an inefficiency in the stock markets. Now, the EMH, efficiency market hypothesis, is a way of taking this random walk and putting it in a little bit more scientific context. And we're saying the same thing, that information is reflected in stock prices fairly and accurately, and the speed is very quick. So whatever stock price you see is the accurate price of the stock. Now, this was broken down into three forms: weak, semi, and strong, to sort of break up, because not everybody believes in this hypothesis or believes in it in the very strong form. So they kind of worked it out to be three different levels. So the weak form is basically saying that past stock price information, so the past information of the stock prices, is no use in predicting the future stock prices. So if the only thing you're looking at is the past stock prices, that's not going to predict the future stock prices. And that's the very weak form. In this weak form, fundamental analysis, looking at the financials, does work. Inside information does work, and those will help you get superior returns. But technical analysis, or looking at the movement of volume and stock prices, will not help you in this weak form. In the semi-strong form, it's going to be talking about fundamental analysis. So the previous chapter, we talked about fundamental analysis. We saw we could use financial ratios and trends to get an idea of how valuable stocks are. In the semi-strong form, it's saying that that's not going to help you. So you cannot make profits by using public financial information, and you cannot make profits by using past stock prices. So in a semi-strong form, the only way to make decent returns is to have inside information, which we know is illegal. But they're acknowledging that that does happen. It gives people an advantage. In the strong form, they're saying no information, public or private would be the inside information, would allow investors to have a consistently strong return. So in the strong form, it's saying the market is efficient at all times, and investors will not be able to make a profit based on any information. It's just a completely random event of, almost like going to the casino and pulling that arm on a slot machine. You have no idea whether or not you're going to win or lose. Sometimes you win, sometimes you lose, but it has nothing to do with the way you pull the slot machine, or the lucky charms you're wearing, or the amount of information you have about the past performance of the slot machine. And some people do that. If you ever go to a casino and there's people who hover and they watch someone play a machine, and the guy's playing the machine and he's losing and he's losing and he's losing, and he gets off the machine and someone else jumps on the machine because they think the next pull might be just the winning pull, because so many losing pulls went ahead of you. But maybe that works on slot machines, but this would say, it's not going to work in the stock market. Although I can tell you that the slot machines have the worst odds in the house. So if you go gambling, don't play the slot machines. Play the card games, the table games. They have better odds, and that's a statistical fact, a probability. I actually read a book where they looked at all the slot machines in the casino, and the ones in the interior pay off more than the ones in the exterior, because they're trying to draw you in. So the ones in the interior, the slot machines, they ring more, they win more, so they're trying to get you deeper into the casino. And the ones in the exterior, by the exits and the doors, where some people may just pop in and play and leave, they pay out less. So there's a whole psychology of where they place these machines and which ones win, and it's pretty crazy the amount of math and logistics and ideas they put into these casinos as far as how they design them and the world they create. Okay, moving on. This is daily stock price reaction surrounding positive earnings news. So positive and negative. So this bottom, this would be the abnormal return percentage up here, 1, 2, 3 times. And down here would be the days relative to the earnings announcements. So we have negative days before the earnings announcements, then we have the earnings announcements. In the first day, we see the most change in the stock. So, and then after the second day, the stock starts to trade back down to its original trading pattern. So there sometimes is a reaction when new news comes into a stock that is going to make an abnormal return. And this has been well documented. Earnings come out, and investors have a hard time interpreting the significance of the earnings, or they overreact and are disappointed or excited reference. And I've noticed most times when you follow a stock and earnings release, whatever the earnings release is, you see the initial reaction, and there's always a pullback the next day. So the next day, so the earnings come out, the stock may go up 20%. The next day, it'll pull back 5%, maybe 10%, maybe all of it. And same with the negative way, the earnings may come out bad, the stock may get crushed, go down 25%, the next day it will pop up. And that's because investors see what happens that gets reported as most active stock or biggest changing stock, and they'll look at it and they'll judge, say, oh, there's been an overreaction, I'm going to jump in the next day and get that stock at a lower valuation. You know, if it goes up too much, you may sell it short. If it goes down too much, you may buy it. You know, there are some other anomalies, such as the calendar effect. So the January effect is something that I'm paying close attention to this year. So the month of January, specifically the first week, but if January is a bad month, then the whole year is going to be bad. And that has a high percentage of correctness. That if January is a month where the stocks go down, like this year, then the whole year is going to be a year where by the end of the year, not every month in the year, but by the end of the year, stocks will generally, something like 86% of the time, be lower. So a lot of times what's going to happen in the stock market is made up in that first week of the first month of January. So if January is bad, a high percentage of the time, the whole year will be bad. But there could be months like February that look good. There's also something called the weekend effect. So a lot of people like to close their positions on Friday and reopen them on Monday because they're afraid of what news may happen on the weekend. And you'll see that the last 2 weeks, we've had very bad Fridays. And that's because people are worried, like, what's going to happen on the weekend? A war? What's Russia going to do? Like, what all this? We don't want to be in the market if something unexpected is going to happen because it's only going to be bad news. So they sell on Friday and then buy back on Monday, and you'll see a jump on Monday stocks. So last week, Monday stocks jumped. This week, Monday stocks jumped. And by the end of the week, you'll see stocks going down again because of this weekend effect. So if you're a trader and you realize the weekend effect is very strong, it's stronger in times of more uncertainty and weaker in times of less uncertainty, then you can actually trade on that. You can sell indexes short on Friday and buy them long on Monday, you know. Or I've actually sell them short, like, say, Wednesday, and start buying them long on Friday afternoon before the market closes, as an example. There's also the small firm effect. So small companies, they outperform larger companies, even after you adjust for risk. So small companies have, over time, a higher return than large companies. So if you take 500 of the largest companies, like the S&P 500, and you look at their return every year, and you compare it to, say, 500 or 1,000 small companies, those small companies generally have a higher stock market return than the larger companies. And I guess some of that effect can be just the sheer fact that small companies can grow a lot faster than large companies. It's almost impossible for McDonald's to double their sales. But it's not impossible a few years ago for Chipotle Mexican Grill to constantly double, triple their sales every year. Because at the time when they were smaller, and their stock was, say, $30 a share, it was easy for them to consistently double their earnings and profits, and now they're, $600 a share or something. But McDonald's, being a larger company, they can't, it's like the Titanic, they can't turn around so fast. They can't double sales and profits so easily. So that's one of the reasons we have this, small firm effect. And that's why some people feel that you should just be invested in the small companies continuously and never even bother with the larger companies because you get a faster return with the smaller companies. But there's been years where that's been the opposite. Sort of, I think maybe even last year, I'm not sure. Okay. post-earnings announcement drift. So stock price adjustments occur during earnings adjustments or after earnings have been announced, but then generally they could be sort of a correction on these. The earnings may come out and there's overreaction and then a drifting back to the norm, which we saw in the chart earlier. Now, a lot of times, if you look deeper into these earnings reports, rather than just the top line numbers, sales increase this much, profit margins and profits increase this much or decrease that much. If you look into it a little bit more, sometimes the explanations of why sales have changed or why profits changed a little bit, there could be other items in there that once you realize aren't going to affect the business ongoing, it's going to change your, for example, TiVo may announce $300 million in profits unexpectedly one quarter. You read into it a little bit more, they won a lawsuit. So it's not operational profits looking to occur every year. It just happened to be a one-time lawsuit they won. So investors that don't know that may jump all over the stock based on its earnings, but it's likely to come back down once people realize that that's not going to reoccur. There's also the value effect. Now, these are anomalies, things that the efficient market hypothesis cannot explain. They happen, and we witness it, and we can test it, and we don't know why it happens, because if it's supposed to be an efficient market, it shouldn't happen. And one thing is the PE ratios to value stock. And there's been a number of studies. If you go in the stock market and you look at, say, the Russell 4000, and you take that and you rearrange them in order of PE multiple, and then you invest in the bottom 500 lowest PE stocks, that's going to have a higher return than investing in the higher PE stocks. So low PE stocks tend to outperform stocks that have high PEs after adjusting for risk, keeping risk the same. And that could just be an idea that low PE stocks are undervalued and they should be gravitating more to a normal valuation, say a PE of 15. If they're under 15, they should normally gravitate closer to that 15. If your stocks are 30 or 25 PEs, they should gradually go lower to that average median PE. So this is sort of an expression of that. And it causes a lot of investors to look what they call value funds are basically based on this. When you see value investing or value funds, they're looking for stocks that have a low PE or undervalued, because over time that valuation will come back when people realize that it's a good company and it makes money. So these are just a graphical. The blue is firms with positive earnings news and the red is firms with negative earnings news. And you can see that there's also this drift after earnings where if it's a good earnings announcement, typically the stock jumps up a lot that day and then continues higher. And if it's a bad earnings announcement, it may drop lower and then continue dropping even lower if it's the start of a trend. Because a lot of times when the earnings shift or go into a new unexpected area, and we get this really great earnings report, like suddenly people have realized that iPods are good, and Apple stock jumped up greatly that first day they got a good earnings report based on the solid sales of the iPods. And then it kept drifting higher as the company became more successful. It's the start of good things to come. On the other side, if a company releases some unexpectedly bad news in their earnings report, generally more bad news is to follow. So there's a momentum that comes with good news follows more good news, bad news usually follows more bad news. So we can see that we can observe this drift. So if the market's efficient, this shouldn't happen. So they have some explanations why maybe this does happen during an efficient market. Is that the risk component may not, stocks may actually be riskier than we think. So that's why we're seeing this difference between what should be efficient and what's not efficient, is because this is a change in the risk or realization the risk is greater than we thought. And some anomalies may just be the pattern that's developing in the data by chance, and it's not really backed by anything significant, and it's not likely to occur or persist. So sometimes we see these patterns, and they're reinforcing patterns, but they're just a pattern that really has nothing behind it and is likely to reverse at any time. And the last explanation could be behavioral bias, which investors have certain emotional sentiments and make mistakes when they invest, and they create these inefficiencies. So when things are going great and everybody's making money in the stock market, small investors just get, treat it like an ATM and keep investing more money and get more excited and see they're making more money and they invest. It's like self-reinforcing to keep that market going up as people are getting, just like you would. If you're putting money in the stock market and suddenly you make more money on that and then more money on that, you're going to keep getting excited and look for more money to put in the stock market because you're making so much money. But the opposite happens too when the stock market goes down and you're losing money and consistently losing money. Then you suddenly want to sell all your stocks, empty out all your mutual funds, and this overreaction by investors on the upside and the bottom side is an explanation for why the market can have these overvaluations and then stock market crashes and undervaluations. Now, because looking at this behavioral finance and its relationship to stock prices, people tend to get overconfident. So we have our own stock trading game, and sometimes people make a few winning trades, and maybe this happened to you. You make a few winning trades, you feel like you're doing good, you get some confidence, so you make even more trades, even riskier, even bigger, and buy in even more. And then suddenly something happens, the market turns, and you get crushed. And that's because you get overconfident. And it's easy to become overconfident in an upward growing stock market where the stock market's reaching new highs, everything's making money. So wherever you're putting your money, you're making money, so you're feeling confident that you know what you're doing. And suddenly the market changes, and then you get crushed, and then you realize, I guess I didn't. So you had that overconfidence that was clouding your judgment. Now, there can also be this self-bias where you're like to take credit for your success but blame others for your failure. So when you can think about this in school. When you do great on the tests, it was all you. You did great on the test. It was because how well you studied and how smart you are. If you did poorly on the test, then it must be the professor's fault. It must be you think of all these reasons why it's somebody else's fault but not yours. It's my parents' fault because they wouldn't let me study because I had to prepare for, clean up the house for guests, or, you always look for somebody else to blame. So this way, if you have this bias, you're not really fairly looking at the circumstances and learning from it, and you're reinforcing your beliefs. So it's very dangerous on the upside. So if you are making some successes and you're saying, I know what I'm doing, and if there is some contradictory information, like some people give you information that the market's going to go down or things could be risky, and you say, oh no, I know what I'm doing and look at all my success, and if I did make a mistake, it was because I listened to this news article about this stock, or this person on TV talking about, Jim Cramer talking about buying that stock, so it's really their fault, and you start believing your own bull. Right. And this basically will sort of encourage you to trade too much. And there could also be, an opposite respect to this self-bias is that sometimes you lose confidence in yourself. You have the right idea, you've done the research, you know this is a good stock to buy, but you don't stay committed to it. So you buy in a stock, and then you may sell it, or you may sell it at a loss even and get out of it because you weren't confident in the research you've done, and the ideas of why this stock should be a good company, and then it takes off later and you say, oh, I shouldn't have done that. This happened to all of us. Sometimes this could work. You can kind of psych yourself out and sell a stock much more quickly because you're not really fully believing in why you bought it in the first place. There's also this loss aversion. No one likes to lose money. So, and you've probably noticed this if you've ever played the scratch off from the lottery, and you stop playing very quickly because you wind up losing more than you win. So maybe you win and you get all excited and you win $20. You go rush back and buy $20 and more tickets, and you scratch them off and maybe you only win $5, and you go back and play $5 more tickets, and then you lose that. And then you just, after a while, you may put some more money in, take another $20 out, buy another $20 worth of tickets with your own money again, and then you lose part of that or all of that. And then finally you realize that this is really a losing game. I don't win enough based on what I'm losing, and then you stop. But in the stock market, there's a, if you buy a stock, and maybe you saw this in the stock trading game, you buy a stock and it starts to go down, but you hold on to it because you want to be proven right. If I can only hold on to it a little bit longer and it goes up, and I can sell it at a profit and I'll be right. But you can be wrong for a long time on the way down for many months, and you may never be right. So a lot of investors have this idea that if my stock I buy goes down 10% or more, I sell it and move on to something else because clearly it's not working. So if you're a momentum trader and you buy a stock and it goes down at a certain percentage, 10, 15%, you want to sell it and go find a stock that's going to go up. And this is sometimes, Peter Lynch calls this picking the flowers and leaving the weeds. So if you had a stock portfolio of 30 stocks, 10 of them are in a loss position, the weeds, you leave them because you're hoping that they're going to turn around and make you money, so you're proven right. But then you might have 20 stocks that made money, and you sell them prematurely because you want to lock in the fact that you were right and you made money on it. So you're selling the flowers, the good stocks, and keeping the bad stocks. And that's going to be a loss in the long run. Okay, representativeness. You're drawing conclusion from a small sample set. You're not really looking at a big picture. You're sort of reinforcing the same ideas with the same, input. So say you think that there's going to be a stock market crash, so you go online and you type in crash or stock market problems, and you start reading all these articles, and they lead you to links of other articles, and so before you know it, you're completely convinced that this is going to happen. But you're too representative in this trend, and you're making conclusions based on being the internet routing you to all these similar stories that are reinforcing this opinion that may be wrong because you're not really getting the full picture. And that's something that as human beings we normally do. Now, narrow framing. Think of a frame of a picture and think of that picture getting smaller, that frame getting smaller, making the picture smaller. Analyzing a situation in isolation. So ignoring the larger context, sort of similar to what I was talking about before. But again, not having a broad enough analysis, not really thinking beyond a small subset of information, and so you're missing the big picture basically, and you're looking at this one small picture, and you're thinking that this is why I should buy the stock, but you're missing the big picture. So you might be saying, I'm going to buy the stock of this DVD manufacturer because they make the best DVD player and I love it. But the sad fact may be that we're moving on from DVDs to DVRs. And maybe you buy TiVo stock because you love the TiVo. Does anybody here have a TiVo? Well, if you just love the TiVo and you think the stock should do well, but then you have to, the big picture is cable companies are incorporating DVRs directly into the cable boxes, and there's less of a need to buy TiVo separately. So those are examples. Belief, perseverance. So this basically you're going to ignore new information that conflicts with your existing beliefs. So say for example, you believe in a particular religion or God. And then one day somebody comes to earth and says, I am God. And I can prove it. I can heal the sick. I could fix your financial problems. I could cure the world's pollution and global warming. And I can take care of the big pile of plastic in the middle of the Pacific Ocean. And I can do anything because I'm self-proclaiming myself God. Most of us will not believe it because we're going to cling on to our beliefs. We're going to say, this can't possibly be God. Even though he can do everything a God can do, I still don't believe it. And there are certain things that you may believe that it's just you're going to cling on to that belief because it's a hard thing to realize that your beliefs are wrong because it really questions who am I and what am I, so we want to fight to preserve our beliefs in, whatever the issue may be. And in the stock market, it's very dangerous. So if your belief is that the stock can do no wrong and you have to own the stock, and nothing they can say to you that, hey, this stock's going to be less valuable in the future because this competitor is going to creep up on them. And you just, nope, I love Blockbuster. Netflix will never outdo Blockbuster. They have the stores, and I'm just going to keep investing in Blockbuster. I don't think Netflix is really ever going to be anything worth anything. No one's going to ever stream movies and TV on the internet because the connections are too slow. You just can't watch the video as well. I'm sticking with my belief that Blockbuster will always be a big stock. And you can see how well that went for that person. we all like what's familiar, and we do have this familiarity bias where we tend to pick stocks that we're familiar with, regardless or not whether they're good or bad buys. So sometimes we have this bias with a certain group of stocks, maybe stocks whose products we're familiar with. So maybe we want to, that's one reason they say sometimes the tech stocks overheat, because people like to say, oh, I know Microsoft and Google and Intel and Yelp and all these different internet brands and things. I'm familiar with what they do. I can see how the product's going to be great, and I'm going to invest in it because this is what I'm familiar with. I'm going to stick with it even when it's proven that these stocks are not good valuations and not a good investment at the time, but people will still stick with them because they're so familiar with them, and that can be a real big drain on stock returns. Okay. Now, the stock return predictability, there is this idea that you can buy stocks that are out of favor, they're profitable, but they're underperforming. The stock price isn't representative of how great the company is. So there's a chance there, many people feel, that you can buy these stocks and make a decent return. Momentum trades and momentum stocks, we look at stocks that their stock prices are continually going up and down in trends over 6 to 12 month horizons. So in a momentum stock, you may have a consistent 6 months where it increases, and then 6 months where it goes down, 6 months where it increases. So they don't move in very short day or week trades. They move in month-long patterns. So this is something that we've seen, this predictability in stocks. They move in momentums. And there's a whole class of investors who do momentum trades. So they find the stocks that have the most upward momentum, and they buy those stocks, and they hold them until it switches to a downward momentum. And people who consistently buy value stocks in their belief that they're going to outperform growth stocks. And people who pursued these constructs have done well and have shown that you can do well in the stock market making these predictable returns. So these, however, have to do a lot with the behavior of people. So when a stock is, sometimes people overly punish a stock and drive the valuation down to a point where it's ridiculously underpriced. And this could happen during a stock market downturn or bear market. And it's just really people piling on the hate for the stock, even though it really doesn't deserve it. And that's what pretty much drives the momentum of stocks higher and lower. So when people love a stock, and they're in love with, there was a long love affair with Apple before that broke a couple of years ago, or I'm not sure exactly when, but it just had a nice, strong, high momentum like Yelp, and before that broke, and Google, which has done well for a while. You can have a momentum stock like Netflix. It goes up, and then they do something to break everyone's love for it, and that was, oh, we're going to start charging everybody double or separately for DVD by mail and streaming, and then suddenly the stock went under 100. But then people fell in love with the stock again, and it's over 400 again. So these upward and downward momentums, when you could recognize them, you want to get on board, because it tends, those stock prices tend to keep going in that same direction for long periods of time. Now, investors' behavior, the human factor, is what makes the stock markets inefficient. So people who believe they have superior information, they tend to trade more, but usually will wind up with lower returns. So people who think I talk with, all these smart people about stocks, and I work on Wall Street, and I got better information. I have access to these research reports. I'm going to trade a lot and buy a lot of stocks. And what we found is that these people have lower returns. Investors tend to sell stocks that have risen in value rather than declined. So why do investors tend to sell stocks that have risen in value rather than decline? Well, sometimes when you see that stock going up in value, you get the idea that this is going to continue, and that momentum bias sort of feeds on itself. So we keep wanting to have a piece. There's a stock, Qualcomm, at one point, and even Cisco at one point, common stocks today that trade around 15 to 18% multiples of PE that were 100 PE multiples, because that momentum came on and people wanted to get in on that stock when the getting in was good. But at some point, it reaches a peak, and it has to turn around the other way, because it can't continue forever, because there's a point where it's just so irrational that everybody recognizes it. And the smart investors start moving their money out first. And then when the stock starts to decline, the dumber investors get worried, and then they collapse the stock as they run out of it as well. And the whole thing is based on people are acting on their emotions, their fear, their greed. Fear and greed are the two biggest motivators that affect people's trading. So they don't really trade based on logic, because we're not computers. And that's why sometimes computerized trading does a little bit better than human trading, because we're trading so much on emotion and fear and greed. And there's a saying on Wall Street that only pigs get slaughtered. I mean, if you're going to be a pig and you're going to sit there and you're going to keep, trying to make these money on these momentum stocks and buying them on the upright and holding them, expecting to make more money, eventually they're going to crash and you're going to get slaughtered. So it's that mentality of, I'm going to stay here and get as much as I possibly can and be greedy and put more money in and let these, changes, this excitement and the momentum of the stock market affect you almost like you're a gambler. Then you're going to get slaughtered. You're going to lose. Just like the casinos know the same concept. And they let you come in and they let you win a little bit, but then they get that greed started in you, and they get this, this excitement level started in you, and then you're just going to basically, you may be up at some point during the day, but you'll never walk away up. You're going to keep playing, think you're going to go even higher, but eventually you walk away losing. Average person leaves Las Vegas losing $800 in gambling money. The average person who gambles will leave Las Vegas with an average loss of over $800. And that's why they can build all those beautiful casinos and fountains and statues and, Eiffel Towers and all those great things, because all that money gets left behind in Las Vegas, because greed and human nature. And they've shown that if you play blackjack and you follow a system, that's why the dealers always win. The dealers have no emotion. They just play based on a set of rules of how they deal the cards. And they have no emotion to it, and they have rules about what they can do. There's no real thinking in there. This is exactly, I have to play, based on these rules. No emotion. They just follow a set of rules, and they consistently win. You, as the other hand, as a player, you're playing on hunches, intuition, how you're feeling, how much you had to drink, and it's just going to guarantee it's going to end ugly for you. And that's the same thing with the stock market. It carries over. So analyst behavior, analysts like to look at this herding behavior, we call it. So we call it the small, stupid investors, the herd. And they tend to have the same, self-fulfilling bias on recommending stocks. And so the analysts sometimes influence the herd, and the analysts are usually wrong when they're analyzing stocks. But sometimes if the herd is running into the stock and is driving the price higher, the analysts are going to want to say this is a good stock, because their point is to recommend stocks that go higher. So sometimes these analysts look at the herd behavior and they see the herd's pushing the stock up higher, so they may be more optimistic about the stock than they should be because of the stock price going higher. So the herd is what we can break investors up into two groups: the intelligent, smart investors who trade on experience and bottle their emotions, don't let it involve in their stock trading, and the herd, the ever-changing group of young and new investors who come in with money and trade the stock market like they know everything. And they consistently make the same mistakes. They're the ones buying the market at the very high levels, and they're the ones selling the market at the very low levels. So they're constantly buying high and selling low. And the more sophisticated money sees the trends happening ahead of time, sees these technical forces, and sells out early and leaves the small investor holding the bag. And when the market starts to collapse, that's when these investors panic and they really drive the market low. And they're selling their stocks at a low price. And they just give up on investing in stocks. And then the smart money comes in, buys at the low price, starts driving the stock market up higher. And then a whole new class of coming of age investors come in and say, wow, stock market's doing really well. I'm going to start putting more money in it. and then they drive it to even newer heights. So this is the continuing trend. So watching the herd behavior is a way of understand where stocks are going right now. And right now, it looks like a lot of the smart money is selling stocks, and this herd money is going in and buying stocks. So the smart money may sell stocks, push the market down a bit. The next day, the herd investor saying, "Oh, there's a discount. There's a sale at Macy's. It's 5% off the market. Let's go in and buy." And they push the stock up temporarily. So if you see these days where down, down, down day, down, down day, up day, does the herd coming in and saying buying things on discount, and the next day is down, down, down. You see this trend changing where eventually that will break the herd and they'll just give up and they'll just sell. And that's when the market will have that capitulation or that bottoming out. And smart investors, experienced investors, see these trends happen over and over and over again, and they trade accordingly. Okay, so if you use behavioral to improve your investing results, one is don't hesitate to sell a losing stock. If the stock is losing and it's not what you thought it would be, and it's turning into a nightmare each day, just get rid of it. It's a weed, pluck it out of your portfolio, put your money in a better stock that's going to start to move up. You don't want to chase performance. So if a stock has overly performed and has gone up tremendously, like when Yelp hit 100, you don't want to be buying Yelp at 100 and chasing that performance, because it's not based on anything real. It's based on over enthusiasm by the herd investors. You want to be humble and open-minded. You know, ego is a real problem on Wall Street. The bigger ego you have, that you think you know what you're doing and you're going to be making money all the time, the more vulnerable you will be to making mistakes. And not being open-minded and listening to new concepts and theories, new types of, a lot of times, you know, people come out with a new computer or a new company or a new way of doing things, and the Wall Streeters miss the boat on those early investments because they don't have an open mind to new technologies. You know, so there are stocks that languish in very low returns and very low stock price for a while because people don't see the potential for them, because, you know, they're not open-minded enough to really consider anything different than how their mind has formed. And that's why a lot of times younger people like yourselves who start trading stocks, who have more of an open mind, have more of the attitude like, I have a lot to learn and I'm going to listen to things and keep an open mind, you could actually trade better than someone who's older, who's kind of fixed in their ways and says, I'm only going to buy this type of stock, or I'm only going to trade in this particular pattern. So being open-minded and allowing yourself to think about some other ways of analyzing stocks, or some new companies, or some new ideas of investing, or some new investing products will be very beneficial to you as an investor. Reviewing the performance of your investment on a periodic basis. A lot of people, you know, it's not one of those special ovens where you set it and forget it. Remember that infomercial? The roaster oven, you set it and forget it. You don't buy the stock and forget about it. You do want to have to constantly go back in reasonable time periods, 3-4 months, and just see on the performance if it's still doing well. And you definitely don't want to trade too much. You're trading too much is a sign of trading on an investment. Trading when you're desperate. You know, maybe you've had these days in the virtual stock market where you were down, you lost you were number 4, and suddenly Professor Nugent becomes number 4, and now you're desperate to beat him again. You're making all these crazy trades, and you just sink to 10th or 11th or 15th place because you traded too much and you got too emotional and too competitive. And that's one thing that happens in the stock trading game that we're playing. People become too competitive, and then it makes you take these desperate moves to really, let's bet everything on this penny stock and hopefully it'll work out. And then it doesn't, and then you lose, and you just, at that point, you just seem like you can't do anything right. Everything keeps collapsing, you know, and that's because you're acting too emotional on your trades. Okay, so let's get to technical analysis. This is something that's going to be covered more so next class, and whatever I don't finish today, I'm going to make a second part of this to continue it that you'll get next time. Okay, so has anybody here ever heard of astrology? Okay, you've heard it. You've never read your daily. Do you know what your sign is? How many people here are Geminis? One person? Anybody here a Scorpio? Okay. Any Virgos? All right. Anybody in Aries? Okay. So the point is, most of us know what our astrological sign is. But would any of us use astrology to trade stocks? Right? Well, it turns out that technical analysis is a little similar to astrology. Astrology is basically looking at where the planets are when you're born. So the planets or stars are the sun is whatever position in the sky, and that means I'm this sign. And this sign, what right now I guess what month are we in? I don't know. Whatever the sign is this month, Aries. This month is Aries, and whatever the characteristics of an Aries is going to be tied to my personality. So that's using the patterns of the sky to try to predict what your personality is going to be like. That's the concept behind astrology. And most people don't believe in it, but it's about seeing signs in the sky and relating it to an occurrence. Just like maybe you're superstitious. Does anybody have a superstition where they don't want to open up an umbrella inside? Put shoes in the bed. Let a black cat cross your path. Walk underneath a ladder. Were you ever on a sports team that maybe you have some sort of ritual before the game that you did to help you win? Like I would touch the wall 3 times. Every player, as we left the locker room, we slapped the top of the wall 3 times. Or if you're Notre Dame, you slapped a little leprechaun before you leave the locker room. Or you don't. There's baseball players that don't have the sex the night before the game. They won't eat a certain meal. Or you ever hear these things? And these are all people are making this association. If I do this, then this will occur. So in the technical analysis, we're saying if we see a pattern, it could be that in superstition you see a bad omen and bad luck happens, or someone dies or something bad happens, or you see and that's supposed to be like a sign. And that technical analysis is, a lot of people view it like that, where you look in the pattern of the stock price and momentum and the volume of trades, and you see a pattern, and it tells you whether or not to buy or sell the stock. That's like the basic, and that's why it's not really, there's no scientific evidence that it works. However, there's a huge amount of traders that use it and make a lot of money. And there's all the shows, CNBC and Kramer, a lot of them talk technical analysis. Have you ever watched any of these financial investment shows and they throw up a balance sheet and start talking about the price to asset ratio and the certain, they don't do that. That's boring. No one wants to look at the balance sheet or income statement or talk about these things. They want to talk about here's the 6-month price trend, and we're touching a support level, and it's breaking through a resistance, and they all talk all technical news and analysis on all these financial news shows because it's exciting. It's what a lot of traders use, and it's these traders swear by it that they're making a lot of money with it. And there's a lot of jobs in this type of analysis area as well. And one thing that people like about it is there's no need to know accounting. You don't have to understand accounting. You just have to understand the financial data. So you look at the financial data to help you determine whether or not to buy the stock. So a lot of this is reflected in charts. How the chart of the stock, we overlay either the volume or the movement in the stock price will help you determine the pattern that's forming to let you know whether or not to buy or sell the stock. And studies have shown that anywhere from 20 to 50% of price behavior can be traced back to overall market forces. And that's the market forces and the redundancies of market forces are what supports technical analysis. Now, I was like you. I was not a true believer. This did not sound like something I would believe in or something I would use. But then I started learning more about it, and I started trading with it, and surprisingly, it became a very successful aspect of my portfolio. So I say, all right, maybe there is something to this because it does seem to be working. Now, I'll show you the methods I use that consistently make returns, and you could judge for yourself whether or not you think that's an appropriate way to judge a portfolio. There are more technical analysts on valuing and trading and investing on Wall Street than fundamental analysts. It's a bigger field. I happen to use both. Since I used to be an accountant, I'm very fond of fundamental analysis, and I believe in balance sheets and income statements and profits and analyzing the change of these ratios and the trends. So I think fundamental analysis is a great way of understanding what companies are financially good companies to invest in. But technical analysis tells me when's the right time to buy the company. So you would have a great company, but if you buy it at too high of a price, you can lose money. So technical sort of clues me into when's the actual time, the best time to buy the stock. Because I know it's a great company, because I want to buy a great company at the right time. I don't want to buy a bad company at the right time, even though that will make me money. Long term, I'll do better buying the right company that's financially solid, strong balance sheet, income statement at the best price possible. And technical analysis usually helps clue you in to what's the better price. So we're going to look at, focus on trends in business, the stock price and the overall stock market run in these different trends. Sort of like fashion, how fashion have trends, certain things are in, and then they go away, and then they come back. Those patterns run in the stock market as well. And now the stock prices are clearly a function of supply and demand. So it's all investor-driven supply and demand. So their thinking process is the way investors think and the way they buy and sell stocks are a continuous loop. You know, the way the investors have emotions, they buy and sell stocks, the way the stock market works, we've seen it's a continuous expansion and contraction cycle. So there's several technical indicators that can be used to help dissect this. One thing we could look at as a technical is this confidence index. And in this confidence index, we could see it's the ratio between the yields on the high grade, high end, the least risky corporate bonds compared to the more intermediate or more risky corporate bonds, and even compared to the very risky junk bonds. So there's real optimism if the yields are close between the risky and not so risky bonds, if the yield's very close, like the solid, we'll say blue chip bonds are at 5% yield, and then maybe the next level under slightly riskier companies are only 5 basis points away at 4.95, we'll say there's a lot of confidence. When that spread when the yields start to spread more aggressively, then we'll say that there's more there's less confidence in the marketplace. So it basically looks at the bond market. So if the yields between the junk, the intermediate, and the superior bonds start getting closer together, then there's more optimism that the weaker companies will be less risky in the future. And if risks start to expand, the risky companies will shoot up in the amount of yield you need to buy those bonds, and the safer companies will only move up slightly. And we will have a bigger gap between those interest rates. Maybe the junk bonds are at 12% and the high grade bonds are at 5%, and you have 11 percentage point difference between the two. That's signs of a problem, because people will sell the riskier bonds first and drive up the interest rates before they'll sell the safer bonds. So this is just a way of looking at the bond market and see what is the bond market telling us between the high yield, the high grade corporate bonds considered to the lower grade corporate bonds. And the closer they are together, the more optimistic the market is. And the farther apart they are, typically the more pessimistic. And since the bond market, they say, can sometimes lead the stock market, that's why they look at this money trend. And this will happen in bonds. Generally, bonds are considered a little bit more reflective than stocks. So if we start seeing this trend occurring in the bond market first, and the confidence index is saying we should buy or sell stocks, we should pay attention to it. Another indicator could be market volume. So last week when stocks were going up, and say Monday or Tuesday, we had what was called a weak market, very low volume. So stocks were moving up, but it wasn't a lot of volume. Then the days that the stock market was going down had very strong volume. So think of volume as the amount of votes. So if you have only a few people voting and the stock market's going higher, it's not as significant than a lot of people are voting. So if you have, record volume trades and the stock market goes up 200 points, that's really good news because you want it to go up on high volume. If the stock market happened to go lower on low volume, not so worried about it. So sometimes this judges the commitment of who's trading and how many people are trading that day, or how many people are voting, yes, I vote the stock market higher, or I vote the stock market lower. So volume plays a key role in the technical analysis to really figure out how significant is it. And we look at things in significance based on how many people are trading in that volume of buying and selling. So every time someone buys or sells a stock, it gets added to the volume. So on days where there's heavy buying and selling, the volume is going to be a lot higher. So if the stock prices are moving higher in high volume, that's a good sign. The inverse would be a bad sign. Now, if we look at the breadth of the market, we want to look at the number of stocks that are moving up for that day, advancing, versus the number of stocks that are declining. So in a strong stock market, we'll see that the number of advancing stocks outperform the number of declining stocks, and we like that. In a weak market, the stocks declining faster than, if the number of stocks declining outnumber the number of stocks advancing, we call it a weak market. All right.